Hello students, welcome to today's episode. Today we will discuss about funds flow statement in detail. I am Dr. Arshia Hussain, teaching in the Department of Commerce and Business Studies, Jamia Millia Islamia, New Delhi. Funds flow statement is a statement which shows changes in financial position of a firm between two different balance sheet dates. Funds flow statement is the statement which analyzes the flow of funds, that is, the reasons for changes in working capital is the funds flow statement. In simple words, it is an analytical statement which analyzes from where the funds have been generated and where they have been used. It summarizes the financing and investing activities of the enterprise during a financial year. Funds usually refers to the cash resources, and funds statement is prepared to show the net effect of various business events on the current resources of the organization. In today's discussion, funds should be understood as working capital, and funds flow mean any change in the working capital. Funds flow statement is prepared to explain the changes in the working capital position of a company. According to Roy A. Folk, fund flow statement is defined as a statement of sources and application of funds is a technical device designed to analyze the changes in the financial condition of a business enterprise between two dates. Now we will see types of funds. See, there are two types of inflow of funds. First one, long-term funds. They are raised by issue of shares, debentures or sale of fixed assets. Second is funds generated from operations. If the long-term funds requirement of a company are met just out of the long-term sources of funds, then the whole funds generated from operations will be represented by increase in working capital. However, if the funds generated from operations are not sufficient to bridge a gap of long-term fund requirement, then there will be a decrease in working capital. Now we will see objectives of fund flow statement. The objectives of funds flow statement are: first one, to show the changes in items of financial position between two different balance sheet dates. Second one, to show the different sources and application of funds. Third one, to show how much of the total funds is being collected by the sale of fixed assets, how much from issuing shares or debentures, how much from long-term or short-term loans, and how much from normal operational activities of the business. Fourth one is to provide information about the specific utilization of such funds, that is, how much has been used for acquiring fixed assets, how much for redemption of preference shares or debentures or short-term loans, as well as payment of tax, dividends, etc. Fifth one is to help management in depicting all inflows and outflows of funds which results in a change in working capital of an enterprise. Next is to help management to exercise budgetary control and capital expenditure control in the enterprise. Now we will discuss importance of funds flow statement. The advantages of funds flow statement are: it helps in the analysis of financial statements. Fund flow analysis shows the changes in the financial position between two balance sheet dates. It provides details of inflow and outflow of funds, that is, sources and application of funds during a particular period of time. Second one is it helps to provide solutions to various financial questions. Funds flow statement helps the management to provide solutions to various financial questions such as how much fund flowed into the business, then how much of these funds were provided by the operations, what are the other sources of funds, how were these funds used, why was there less or more amount of net working capital at the end of the period than at the beginning, and so on. Next is it helps the management in taking rational dividend policy decisions. Funds flow statement shows the working capital position of a firm and helps the management to take a policy decisions on various matters such as dividend decision and so on. Next is it helps in proper allocation of resources. A funds flow statement enables the management to take proper decision regarding the allocation of limited financial resources among different projects on priority basis. Next is it is a guide to future course of action. The future needs of the fund for various purposes can be known well in advance from the fund flow statement. Accordingly, timely action may be taken to explore various avenues of fund. Next is it helps in the proper management of working capital. This helps the management to use the surplus working capital profitability or to locate the resources of additional working capital in case of scarcity. Then it is a guide to investors. It helps the investors to know whether the funds have been used properly by the company. The lenders can make an idea regarding the credit worthiness of the company and decide whether to lend money to the company or not. Now we will see limitations of fund flow statement. Funds flow statement suffers from the following limitations. Number 1, the information used to prepare funds flow statement is historical in nature. Second one, it does not disclose the structural changes in financial relationship in a firm. Next is, it is not foolproof. The funds flow statement is prepared from the data provided in the balance sheet and profit and loss account. Hence, the faults in financial statements will be carried over to the funds flow statement also. Next is, it does not take into account non-fund items. Now, we will see rules of funds flow statement. We know that working capital is equal to current assets minus current liabilities, that is WC is equal to CA minus CL. From this we may assume first an increase in current assets or a decrease in current liabilities leads to an increase in working capital. Second, a decrease in current assets or an increase in current liabilities lead to a decrease in working capital. Third one, a simultaneous increase in current assets and current liabilities or a simultaneous decrease in current assets and current liabilities will have no effect on working capital. A flow of funds takes place only if a transaction involves one current account and one non-current account. On the basis of these general rules, following conclusion can be made. First one, transactions which involve any current accounts, that is current asset or current liabilities, do not result in a flow of funds. Second one, transactions which involve only non-current accounts, that is non-current asset NCA or NCL, which is non-current liability, do not result in a flow of funds. The third one is transactions which involve one current account, that is CA or CL, and one non-current account, that is NCA or NCL, results in a flow of funds. The fund flow analysis involves the preparation of two statements. First is a statement or schedule of changes in working capital. Second one, a statement of sources and application of funds. The first one we will see is statement or schedule of changes in working capital. The schedule or statement of changes in working capital is a statement that compares the change in the amount of current assets and current liabilities on two balance sheet dates and shows the impact of changes in current assets and current liabilities on working capital. Okay, we can see this proforma. We are given with the particulars, then previous year, current year, and finally the effect on changes in working capital in the form of either increase or decrease in working capital. So, under particulars, we can see that first of all we have current assets. Under current assets, we have cash in hand, cash at bank, short term investments, bills receivable, sundry debtors, prepaid expenses, closing stock, other current assets. The amounts are given for the previous year and the current year. Next, we have total current assets. That means the summation of all the current assets will be our total current assets, which will be in the form of, say, A. Next, we have the current liabilities: bills payable, sundry creditors, outstanding expenses, bank overdraft, short term loans, proposed dividend, provision for taxation, and then other current liabilities. The summation of all this will be total current liabilities, say B. Now we have working capital. Working capital will be found out by deducting B from A, that is by deducting current liabilities from the current assets. So, thus working capital is equal to A minus B, that is current assets minus current liabilities. Now, this will either give us net increase or decrease in working capital. Second one is funds from operations. The next step is to prepare the funds generated only from the operating activities of the business and not from the investing or financing activities of the business. The funds from operations shall be prepared as follows. First of all, we have particulars. In the particulars, we can see the net income which will be taken in the first instance. Then we will have to add depreciation on fixed assets, then amortization of intangible assets, then amortization of loss on sale of investments, then amortization of loss on sale of fixed assets, then losses from other non-operating incomes, then tax provision which is created out of current profits, then we have proposed dividend, then we will have to consider transfer to reserve. After adding up all these items, we will have to deduct, that is less deferred credit, then profit on sale of investments, then profit on sale of fixed assets, then any written back reserve and provision. Now, the third one is funds flow statement. The next step is to prepare the funds flow statement. It is prepared to find out the different sources and application of funds, the sources from where the funds have been generated and the uses to which these funds have been applied are disclosed in the funds flow statement. This statement is also sometimes referred to as the sources and application of funds. A statement or schedule of changes in financial position. The statement may be prepared either in T form or in vertical form. The sources of funds are: first, issue of shares and debentures for cash. The total amount received from the issue of shares or debentures is to be shown under this head. But the issue of bonus shares or conversion of debentures into equity shares or shares issued to vendors shall not be shown here, as there is no inflow of cash. Second one is long-term loans. The amount received on raising long-term loans is shown under this head. Short-term loans are not to be shown here, as their treatment has already been done while preparing the statement of changes in working capital. Next is sale of investments and other fixed assets. The total amount received on the sale of investments and other fixed assets is to be shown under this head. Next is funds from operations. The funds generated from operations are computed in step number 2 are also required to be shown here. Next is decrease in working capital. This would be the balancing figure of the statement and will come from changes in working capital statement. The application of funds are: first one, purchase of fixed assets and investments. The cash payment made for purchase of fixed assets and investment is an application of funds, but if the purchase, if made by issue of shares or debentures, such as a transaction will not constitute application of funds. Similarly, if the purchases are on credit, these will not constitute funds application. Second one is redemption of debentures, preference shares and repayment of loan. Payment made including premium less discount is to be taken as fund application. Next is payment of dividend and tax. Payment of dividend and tax are to be taken as applications of fund if the provisions are excluded from current liabilities and current provisions are added back to profit to determine the funds from operations. Next is increase in working capital. This would be the balancing figure of this statement and will come from change in working capital statement. Now, we will have a look at the proforma of funds flow statement, T form. So, we have funds flow statement for the year ending. Now, on left hand side we have sources of funds, on the right hand side it is application of funds. Under sources of funds it is trading profit or funded from operations or funds from operations. Next is issue of share capital, then we have issue of debentures, then raising of long term loans, we have receipts from partly paid up shares, next shares called up, next sale of fixed assets or investments, next non-trading receipts. For example, dividend. Next we have net increase in working capital. Under application of funds we can see trading loss or funds lost in operations. Then we have redemption of preference shares, then it is redemption of debentures, then repayment of long term loans, then purchase of fixed assets, then purchase of long term investments, then payment of dividends, then payment of tax, and finally we have net increase in working capital. So, basically either it will be net increase in working capital or net decrease in working capital, whichever the case is. Next is the vertical form of funds flow statement. Under vertical form, we will prepare funds flow statement in the following manner. First of all, we have sources of funds. The same items will be repeated, trading profit or funds from operations, then we have issue of share capital, then we have issue of debentures, then we have raising of long term loans, then we have receipts from partly paid up shares called up, then we have sale of fixed assets and investments, then we have non-trading receipts such as dividends received, and then we have net increase in working capital. So, which is again the total shows the following. Next is application of funds, trading loss or funds lost in operations. Next application of funds is redemption of preference share capital, then next it is redemption of debentures, then it is repayment of long term loans, then purchase of fixed assets, then purchase of long term investment, then we have payment of dividend, then it is payment of tax, then the result is net increase in working capital. So, as told to you earlier, either it will be net increase or decrease in working capital, whichever the case is. Now, let us see an illustration on this. From the following profit and loss account, compute the funds from operations. So, we are given profit and loss account. The profit and loss account shows on the debit side salaries rupees 5,000, rent 2,000, depreciation 1,000, preliminary expenses 2,000, loss on sale of land 5,000. Then you can see on the credit side profit, which is balance brought down 1,000, then we have rent, it is 5,000, interest on investments is 4,000, then we have net loss. The debit side shows all the losses and the credit side shows all the profits. Now, the summation and the difference between the two will give us either the net profit or the net loss. In this case, we have a net loss of 5,000 rupees. Now, we can see the solution. First of all, we will prepare funds from operations. Under funds from operations, as you can see, net profit as per profit and loss account given to you is 5,000. Now it is in net loss, so we will write as minus 5,000. Next, items which do not decrease funds will be added back to the net profit or net loss. So under the items we have first depreciation, which is rupees 1,000, preliminary expenses rupees 2,000, then loss on sale of land rupees 5,000. So the total of all these items will be rupees 8,000. Now after doing the balancing, we will get rupees 3,000, which will be called as funds from operations. Now in the solution, it may be important to note that rent and interest on the investments are not the items of operating incomes. While calculating funds from operations, non-operating incomes will have to be excluded. These items are shown as a source of funds in the funds flow statement. Now we will see funds flow statement. Now next we will prepare funds flow statement. Under the funds flow statement we have first of all sources. In the sources we include funds from non-operating income, which is rupees 9,000. Then applications we will write. Under applications we have outflow of funds on account of operations, which is rupees 6,000, and this 6,000 basically is the result of rupees 3,000 minus rupees 9,000. So this gives us increase in working capital of rupees 3,000. Now we will see one more illustration. B Limited funds flow statement for the year ending 31st December 2017. The sources and applications are given to us, that is the funds flow statement for the year is given to us. Under the sources we have the items of funds flow operation, 2,26,500. Then we have sale of plant and machinery, which is 44,000. Then we have decrease in working capital, which is 32,500. For applications we have purchase of plant and machinery, which is 1,80,000. Then payments of interim dividend 25,000. Payment of dividend we have 30,000. Then we have payment of tax 35,000. Then it is redemption of 6% debentures, which is 30,000 rupees, and finally we have payment on interest, which is 3,000. So the total of both the sides is 3,03,000, and after balancing we will find decrease in working capital, or decrease in working capital is given to you as 32,500. Now we will see working note on this. First of all, we will have to make plant and machinery account. So for plant and machinery account, as you can see on the debit side we have the opening balance, that is the balance brought down, which is 2,40,000. Then we have profit on sale of machinery, which is 4,000. Then the balancing figure is in the form of bank account, which is 1,80,000. But this balancing figure will be obtained after the balancing of both the sides. On the credit side you can see it is bank, which is 44,000, then provision for depreciation 20,000, then the closing balance 3,60,000. So the total of both the sides is 4,24,000. So after deducting 3,60,000 from 4,24,000, we will get a balancing figure which will be written as to bank account, which is 1,80,000. Next account is provision for depreciation account. Provision for depreciation account, on the debit side we have plant and machinery, that is 20,000. Then we have on the credit side we have opening balance 80,000. Then by reserves and surplus it is 40,000. Closing balance will be 1 lakh. So this closing balance is obtained after doing the totaling of the credit side, which is 80,000 plus 40,000, which is 1,20,000, and hence plant and machinery figure will be deducted from total 1,20,000, which will be the balance, that is the closing balance of plant and machinery, which is 1 lakh. Next is provision for income tax. Under provision for income tax you can see debit side and credit side. So, we will start from the credit side, which is the opening balance, that is by balance brought down, which is 30,000. Then we have by reserves and surplus, which is 30,000. On the debit side, we have bank, which is 35,000. So, the total of the credit side is 60,000, and then this 35,000 rupees will be deducted from total 60,000, and hence we will get the closing balance in the form of balance carried down, which is 25,000. Next is reserves and surplus account. This account shows on the debit side debenture issue expenses, then debenture interest, then interim dividend, provision for depreciation, provision for income tax, bonus dividend, and dividends. On the credit side, you can see the opening balance, which is balance brought down, which is 1,50,000. Then we have profit on sale of machinery 4,000, and then funds from operation 2,26,500. So, again we will do the total of both the sides, and we will find credit side to be more than the debit side. So, the total of credit side comes out to be 3,80,500, and hence the balancing figure or closing balance of reserves and surplus is 1,40,000. Now, let us summarize what we have done today. We discussed funds flow statement. Funds flow statement is an analytical statement which analyzes from where the funds have been generated and where they have been used. It summarizes the financing and investing activities of the enterprise during a financial year. There are two types of inflow of funds. First is long-term funds, and the second one is funds generated from operations. The objectives of funds flow statement is to show the changes in items of financial position between two different balance sheet dates. Then to show the different sources and application of funds. Then to show how much of the total funds is being collected by the sale of fixed assets, how much from issuing shares or debentures, how much from long term or short term loans, and how much from normal operational activities of the business. And then finally, to provide information about the specific utilization of such funds, that is how much has been used for acquiring fixed assets, how much for redemption of preference shares, debentures or short term loans, as well as payment of tax, dividend, and so on. Funds flow statement provides many advantages. It helps in the analysis of financial statements. It helps to provide solutions to various financial questions. It helps the management in taking rational dividend policy decisions. It helps in proper allocation of resources and helps in proper management of the working capital. Finally, we discussed the important rule of funds flow statement. We know that working capital is equal to current assets minus current liabilities, that is CA minus CL. Now, from this particular equation, we may assume the following. First, an increase in current assets or a decrease in current liability will lead to an increase in working capital. Second, a decrease in current assets or an increase in current liabilities will lead to a decrease in working capital. Then a simultaneous increase in current assets and current liabilities or a simultaneous decrease in current assets and current liabilities will have no effect on working capital. A flow of funds takes place only if a transaction involves one current account, that is CA or CL, and one non-current account, which is NCA or NCL. So, that is all for today. Hope you have understood today's topic, that is funds flow statement. So, we will meet in the next episode with a new topic. Till then, take care. Goodbye.